Hello everybody, it's Yashar here, back again with another video, and in this video I will revisit Aritzia stock and discuss the recent earnings report which released yesterday and made the news headline today at multiple sources. And well, it wasn't as expected. The shares of Aritzia dropped by almost 10% after this earnings report, so we should see what is really going on here and why market reacts so negatively to this report. Finally, I want to update my valuation of Aritzia from the last quarter with the new financial data we received yesterday. There's a lot to cover today, so let's jump right into this. Aritzia is the largest holding in our stock portfolio. We have over $10,000 invested in this company, and it actually was the best performing stock for me during the last year. This is a quality company with top of the line business metrics in growth, profitability, brand quality, and value creation, in my opinion. They increased their revenue by 100% in the last 3 years. 100%. That's more than 30% year over year top line growth in their business. Their bottom line is also growing fast. Similar to revenue, their diluted earnings per share increased by 100% in the last 3 years, which is great. This is the sign of a fast growing company. Their average return on equity and return on invested capital in the last 5 years was 24% and 14% respectively, which were great numbers. But even better than that, in the last 12 months, these figures were 32% and 17.98%, which demonstrate the quality of their business and how profitable it is. The company has not only amazing growth and profitability metrics, but also they are buying back shares of the company, returning value to investors. They bought back almost 1.6% of total outstanding shares in 2022. It's not much, but it is the right trend into the right direction. This is a company that knows their customers pretty well and was able to connect to their customers who are mostly young women, business women, and teenage girls, and make them loyal fans and supporters of the brand. They now have a brand quality which is very important factor in my opinion. The company currently operates over 113 boutiques in US and Canada and growing at a rapid pace, particularly in United States by opening almost 8 new boutiques per year, while they are also growing their e-commerce business. And this is why I basically invested in Aritzia as our largest position. Yesterday, the company released its new earnings report while everybody concerned about consumer spending on semi-luxury items like Aritzia clothing products, especially when Lululemon earnings report was also a disappointment recently with lower margins. This was an okay earnings report in my opinion for Aritzia. The numbers were not that stellar as previous earnings report, but they were not bad at all. Q3 net revenue up 37%, net income up 8.9%, and their adjusted earnings before deductions and tax was also up 9.5%. The top line growth was fantastic, similar to previous quarters, and while bottom line growth was slightly slower, it is still growing very fast. The CEO of the company, Jennifer Wong, explained the overall financial results of the company. She mentioned the outstanding momentum in our business continued through the record-breaking third quarter of 2023, resulting in net revenue of $625 million, the highest of any quarter in Aritzia's history. All geographies and all channels contributed to our better than anticipated results, fueled by tremendous client response to our collection of beautiful products and our everyday luxury experience. She continued, revenue in United States grew 58%, driven by our growing brand awareness and exceptional comparable store sales results. Total e-commerce revenue increased by an impressive 36% on top of 47% last year, showcasing the strength of our multi-channel business. As you can see, the growth numbers are still pretty amazing, considering we are probably in a recession, or at least we can say we are in a tight economic cycle, and Aritzia is selling discretionary items. I really like the growth numbers here. So let's focus on the things that I don't like in this earnings report, and I think the market is also didn't like it. First, selling, general and administrative expenses was up 48% year over year, which is a lot. They mentioned the increase in SG&A expenses was primarily due to additional investments in retail talent to ensure the company continues to deliver exceptional client service, as well as ongoing investments in talent, marketing, and technology to support its growth. I don't like to see administrative expenses grew by 48% year over year, while the revenue is up 37%. Capital cash expenditures were also up basically year over year. You can give them a pass here, but these increase in expenses are not positives. Second, gross profit margin is down. Margin compression was expected according to the last investor event. The company sees even further margin compression by 250 basis points into next quarter as well. In the statement, they mentioned these margin compressions reflecting additional warehousing costs related to inventory management, ongoing inflationary pressure, and foreign exchange headwinds. Finally, inventory level, which is, in my opinion, the main source of the problem here in this report. The inventory level is up 185%. Yes, that's correct, 185%. This is concerning, and here is Aritzia description of the situation. The supply chain environment was dynamic and uncertain at the time. The company began placing orders for fall and winter products over 12 months ago. As a result, the company made the strategic decision to order future season buys earlier in order to build back its inventory base due to unprecedented sales growth and mitigate supply chain risks and ensure the company's ability to fuel robust demand for its products. On top of that, improved freight timelines resulted in inventory arriving even sooner than anticipated, contributed to the year-over-year increase. The company is comfortable with its inventory position to meet client demand and expect normalized markdowns in the fourth quarter to be no greater than pre-pandemic level. They also mentioned in the call that vast majority of inventory is client favorites, proven sellers, and they don't see any problem selling this excess inventory in the next year. This is the part that market does not seem to agree with Aritzia. The market probably expect them to mark down prices heavily, which will further reduce the margins. The only thing that I can say here is that the sales into holidays is not yet reflected here. And I believe those lines that I observed in front of Aritzia store during Boxing Day and holiday season will probably can help with the inventory situation a little bit. Despite these challenges, the outlook growth of Aritzia is great for the next year. They expect net revenue in the range of 2.14 billion to 2.16 billion, representing an increase of approximately 44% from 2022, up from company's previous outlook. They also expect 8 new boutiques, including 7 boutiques in US and 1 in Canada, and 5 boutique expansions or repositions. Overall, this report was definitely not bad, and 10% decrease in Aritzia share price is definitely a little bit overreaction here, in my opinion. I am happy to continue to be a shareholder of Aritzia, and if the share price drops below $42, I would be a buyer of this stock again in 2023. With this new information in mind, let's revisit Aritzia valuations and update my last quarter model. So I use a discounted future earnings model here, which basically estimate the value of the stocks based on projections of their future earnings. So I make some assumptions about the growth of the company in the next 10 years and then discount the future earnings into the present value of the stock based on my expected rate of return. So I start with diluted earnings per share of the company, and based on 3 different scenarios, I predict the future earnings per share of the company in the next 10 years. In the bear case, or the most negative case for the stock, the company can grow by 10% in the short term, and then the growth will drop to 7% in the long term. I consider terminal multiple of price to earnings of 10 for this case, which is consistent with historical bear periods for this type of businesses. This is the case that Aritzia fails significantly in coming quarters, and as it is not a probable outcome, I give this scenario a 25% chance. For normal case, I consider a little bit better growth and a terminal multiple of 20, which is the historical average multiple of a growing fashion business. I assign a 50% chance to this scenario. For the bull case, or the best possible outcome, I consider the business grow by 30% in the short term, and then the growth drops to 16% in the long term. And I considered a terminal multiple of 30, which is a bull multiple for a fashion industry in the long term. Right now, Aritzia has almost the same price to earnings ratio. This is almost what management of Aritzia predicts for the future expansion of Aritzia. I assigning a 25% chance to this scenario as it is ideal growth model for the company, and I'm not sure if they can basically hit these targets. For riskier growth stocks, I usually expect 15% return, and for dividend stabilized stocks, I expect 10% return. This is important. For most companies, I put 10% as my expected rate of return, but for Aritzia, as it is riskier than a company like TD Bank or Google, and their future earnings are more uncertain, I put 15% here so I can have a margin of safety. So if I expect 15% return year over year from this stock, the fair value of the company is 49 Canadian dollar, which means compared to the current share price of almost $46, the shares are traded at close to their fair value today and at a 6% discount. It means if you expect 15% return on your money year over year, this stock is probably going to deliver that 15% return in the next 10 years. The results, as expected, are not much different from last quarter valuation, and I believe Aritzia is fairly valued today based on this model. There you are, guys. I hope you enjoyed the video, and if you enjoyed the video, consider subscribing to the channel to see similar videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.